Hello, everyone, and thank you for joining us today on the Dairy Signal. We're going to be diving into a market update here in just a moment. But before we do so, it wouldn't be a Dairy Signal without a little bit of today in history. And today we are headed to 1953 as two gentlemen do what was thought to be the impossible, and that is they reached the summit of Mount Everest, becoming the first known explorers to reach the top. And their names are Edmund Hillary and as well as the Sherpa Tenzing Norgay, and they are the first human beings to do so. It has definitely been on the radar for some time at this point because back in 1921, the first explorers tried and ultimately failed. But it was on this day that, well, like I said, what was thought to be the impossible happened. So that is your fun fact for this afternoon. But I know you are here to dive into a market update and learn about what's going on in the world of agriculture and dairy markets. So without further ado, Ben, welcome back, and I'm going to turn it over to you to get us started.
As always, a pleasure to join you and the PDPW team. And we'll jump right into it. And I think that this is going to be kind of a rehash of things we've talked about for a long, long time in the dairy space, but we will kind of revisit, see where we are in the world marketplace. It's still very competitive, the US is, and kind of check in on global production and what this means for, price evolution for the next 3 months, 6 months, maybe 12 months. But the message we've got, I think, is pretty positive for the dairy space in the US. Increasingly, we are the ones with a milk production growth, and so dairy product surpluses. And I think that those surpluses will find the import market pretty quick. We are the place to be if you want to buy dairy products and you're an importer. We do want to communicate, though. I think the feed outlook to us is turning a little more bearish. So if we do have corn producers joining us today, I think it does make sense to do something risk management wise, at the market or close to it, certainly on recoveries. And that's just a function of weather. Weather has been a lot better than everyone thought with respect to water availability in the US. And then we'll touch on what's happening in Brazil, further on down in the hour. But overall, I think that the theme is, from a very high level, milk feed ratios widen, especially the second half of summer, maybe the second half of calendar year 2025. We are neutral to a little supportive of the milk market, the dairy space as a whole. We are concerned that corn may have to find a price that increases demand for the first time in about 6 or 8 months. And that probably doesn't happen in full until we know what weather is like, or at least the weather is forecasted during pollination. But the runway now is, a matter of weeks. It's not months anymore. We do have, confirmation that U.S. milk production is ongoing. It is accelerating a little bit. I think the U.S. Milk production is doing very well. And that probably continues throughout summer. We think that production growth stays at about 1% year over year. In the grand scheme of things, we're still not seeing the growth that we saw, prior to 2020. We're still, a long ways away from that. But this is different than the last couple of years, and what we kind of saw as of late spring, early summer. We on paper weren't going to have enough milk, and we saw $22, $24 class 3 prices. That may not be the case just because the US will have milk, at least for the next 4 or 5 months. Partially that's comparing production this summer to very weak levels a year ago, but in any case, I do think we're kind of guaranteed growth of production in 2025. But same trends hold worldwide. No one else is. When we isolate parts of South America, but especially New Zealand, Australia, and Europe, they are struggling. And I think this could get worse in places in Western Europe during the summer and maybe through the rest of the calendar year. So, what we're producing is being offset to a large degree by higher share of world trade that the US has gotten and I think keeps for the rest of this year. The feed market outlook, like I mentioned, turning a little more bearish if Mother Nature cooperates in the Midwest, which is always the case. But the shrinking of drought coverage in the US has been pretty dramatic over the last 2 months, to the point where it may be very sparse come June 10th, June 15th, which I think we know how the market will handle that at least. If there's not a water problem first half of summer, it's probably going to shed more risk premium. And the highlight too is the Brazilian corn crop. It's just this unceasing nature of the wet season there. They have gotten rain as of May 28th, which is highly abnormal. Normally that Brazilian winter corn crop pollinates with no water. And so as we debate Brazilian production every year, it's always between, is it 80 bushels an acre or is it 90 bushels an acre? And that's what you get, of course, when you don't have water at reproductive stages. But this year, a lot of places did get water during pollination. So, the idea is that Brazilian production estimates are going up very quickly. People kind of leapfrogging each other now. We won't get married to any one number, but it is probably higher than USDA's forecast, and generally will be pretty robust. So thinking about corn 3 and 4 months from now, record U.S. production colliding with uh, pretty steep competition for exports. Now, given we've got production rebounds in Brazil, Argentina, most probably Ukraine. So it's a very different market than it was last September, October, when we found a bottom pretty quick, and then it was off to $5. You need a new supply threat, I think, for that to happen. This is the high level message from the early part or later part of spring, at least for the next 2 weeks until something changes. Is these ratios are very wide currently and probably get a little wider. So thinking about protein meal, this has been the case for the last 12 months almost, but we think that stays the case. Soybean meal probably perfectly valued, at least at the Board of Trade, between $290 and $300 per ton. And one of the features of a market that is pretty well supplied and is cheap is that you don't have any volatility. So it's very hard to be bullish with meal unless there is a pretty big threat to U.S. soybean production. But at the same time, since you're lacking volatility, I don't think there's a bear argument to be made as well. So the kind of ratio stays 1.3, maybe 1.4 again, second half of 2025. The milk corn ratio is also recovered. And I think this is the one that widens further. We are concerned that the corn market's goal transitions from kind of rationing available supplies. Export demand has just been so incredible. The market at $5, a couple months ago was kind of thinking, what does it need to do to keep U.S. end stocks this year at 1.3 or 1.4 billion bushels? Now that is kind of being sorted, and we've got perhaps a supply-driven bear ahead of us. And so, again, if we've got surplus corn, if we are corn farmers, we want to be pretty active in managing that risk, given we won't shed the entirety of risk premium until July, but that's forthcoming. It's every week that we don't see a weather threat, are kind of closer to getting to that point. But for the dairy operators, I think these all look pretty good to us. I don't think they certainly weaken. And again, I think these milk feed ratios get a little wider second half of the year. As for the dairy markets themselves, pretty unremarkable price action. We had asked the question during the winter months: is the market butter, cheese? Are they concerned about economic performance in the U.S. globally, the loss of Chinese demand, something unique happening, or was it just what the markets always do in Q1? I think that question has now been answered. It was just pretty normal seasonally. It's just to reiterate, the U.S., no matter what, always builds butter stocks, and pretty considerably during Jan to May or June period. That happened. Market was weak, but now the market's finding life because we are exporting butter for the first time in a couple of years. And it will touch on butter stocks, but they are not terribly robust all of a sudden. And we know that this descent in inventories lies just ahead of us. So, I think that the butter market is more actively digesting, once again, the potential for very tight supplies during peak consumption periods around the holidays. So it will be active in accounting for that, I think, during the summer. And cheese is just kind of a function of, U.S. milk production rising, but also record or near record export demand. We're also finding, as we get into sort of the monthly puzzle, domestic use and total consumption of all the stuff is pretty good. I mean, I think butter demand is by far record high, and that has been the case for the last year and a half. Nothing really surprising in cheese too. We're using a lot of cheese. So as the market has access to more raw milk supplies, a lot of that supply will be forced into cheese and then out the door out of the country, because we are the place to buy cheese, of American varieties especially. So when we think about the future, I still think there is some upside risk here. The target for cheese would be something like $2.10 or $2.15 versus, the forward market's about $2 per pound today. That's pretty easily, I think, a $20 class 3 market. Now, it will ebb and flow. Today, we are losing some value. It's not going to be straight up, and there will be some volatility, but I think that's kind of our new target. A target that we would be prepared to hedge just based on risk management practices and being able to sleep better at night. But I do think that's a pretty reasonable target for contracts between now and maybe October or November. And butter, I think, is changing very quickly. The cash market, which was stuck for many, many weeks at either $2.30 or $2.35. It's now $2.52. And it's still incredibly cheap in the global space. So either we have to see these foreign markets like in New Zealand or Europe drop pretty considerably, or I think the target late summer, early fall is something close to $3 in the cash and futures market. So that's going to be valuable. We want to produce for those components. Just keep that in mind as the butter market starts to add pretty substantial premium, at least over the next 90, 100 days or so. Now, again, with the, we could have seen the last 2 years, it's pretty easy to see, $22, $24, $25 class three. It was just the risk was totally misaligned during the spring. Because you can kind of see here in this graphic that we have not been able to produce more milk year over year on a sustained basis really since 2020, early 2021. That's kind of happening now, and we are seeing some kind of structural support for this. We're adding to cow numbers. I think bird flu, while not gone completely, is being managed pretty well, and we're kind of hearing rumblings, and I don't want to speak to anything concrete, but that vaccines may be on the horizon. There's still red tape to get through, and again, I have no idea exactly how that works, but I think the industry is prepared to battle this further should it return in bulk. So the U.S. milk production in April officially 19.4 billion pounds. That was up 1.5% from the previous year and the highest growth rate since summer 2022. We kind of do our normal work of thinking about, not just cow herd numbers, but the seasonal trend in cow herds, and kind of analyze what's been pretty decent yield improvement along the West Coast. We do think that U.S. milk production will be up between now and September, 0.5% to maybe 1.2%, and probably locked into growth of 1%, June, July, August, we think. So just keep that in mind, as we're debating what exactly is upside in cheese, butter, and class three. I do think scaling into rallies makes good sense. I also want to communicate as we're doing this, the cash milk, and partially this is because I think class four is a little undervalued today. All milk cash premiums will be intact, and those will, I think, still be $2 or $4 a hundredweight. So as we're hedging $19.5, $20 class three, that's, I think, 22, 23 cash milk in Wisconsin, and really pretty much across the entire Midwest, maybe the whole country. So I think we're a little more comfortable, just kind of passing off some risk. And also, this as an aside, we want to think about what is always the worst time of year, Q1, of course. And so market kind of evolves the same almost every year. So as we get closer to late summer, early autumn, when these seasonal trends do tend to peak, think very hard about hedging or forward contracting January to April production of 2026. That is the time to do that. So we will revisit this on future signals, maybe be a little bit more firm in recommending that, but just something to think about as we do have this kind of new landscape in the market, which is supportive, if nothing else. And this is kind of what it looks like, and this is why I think we do have to contend with larger U.S. milk supplies. So U.S. dairy cow numbers are up 89,000 head from last year and up 50,000 head just since the end of December. And a lot of this is occurring in Texas, where we're rebounding from avian influenza. Growth has also returned to South Dakota, which was kind of a prevailing trend prior to 2023. But that is where we're seeing the most growth. But everything is important, so just it is important to note that we are growing the U.S. cow numbers. Now, seasonally, we probably lose cow numbers after May or June. But will it be enough to kind of reduce total U.S. milk production forecast? Probably not. And on the right, you see that for 3 months in a row now that we have had higher per day, per cow output numbers. So we are finding some yield growth finally for the first time in a long time. And again, we'll need to analyze per cow numbers every month just because it hasn't been guaranteed. We tend to go through quarters where we do pretty well, and then the following 6 months do pretty poorly nationally. But I do think that there is support, and if it just comes down to California at least, kind of managing things, getting back to where they were a year ago, bodes well for national yield potential for milk. So U.S. milk production will be, I think, pretty good, at least through autumn, probably through the rest of 2025. So that's not a pillar of support like it has been the last 2 years in the market. And here's what California yields look like. So the doldrums of kind of October, November, December of last year, bird flu, I think the worst of that has passed. Yield in California in April was 2,035 pounds, just 2% below the previous year. So again, I think we're getting back towards something like normalcy along the West Coast. And we knew that was inevitable at some point, but we do want to highlight that it is occurring now. And just, at Ag Resource, a very big picture, how do these, markets move over the course of 6 and 12 months? This is just important to note why we're more willing to hedge rallies than we have been the last 2 or 3 years. And this is what the annual kind of outlook looks like. So the USDA in their May WASDE raised U.S. milk production by 400 million pounds to a record 227.3 billion, which we don't have a major disagreement with. Maybe we're even overthinking this, but if we kind of account for what I think will be, a trimming of cow numbers, which is pretty common in normal years after spring, early summer, we kind of assume that the yield growth continues, but maybe modestly. We are a little lower than USDA. Maybe the USDA is 100 or 200 million pounds too high, but at the same time, we are locked into growth for the first time since 2021. So that picture is beginning to evolve a little bit. So that's kind of the supply-driven bear side of the market. But what's being offsetting clearly, the U.S. milk production report was out last week, and we've only added premium to a lot of contracts since then. So that is clearly to us not the majority of what's driving price discovery. It is probably the world market that we've highlighted a lot and the potential for exports. So if we just isolate the May USDA report, they raised U.S. milk production in 2025 by 400 million pounds, but also raised fat-based exports a similar amount. So those are kind of completely offsetting. Cash prices were raised across the board just based on price action to date. And I think, when we just look at the snapshot, which we will in just a bit, of the world market today, since all of this analysis was done by USDA late April, early May, we're still just so incredibly cheap in the world marketplace. So this could be 400 million pounds too low. Maybe we do rival the record fat-based export program of 2022. I think there's evidence to support that. As of today, the tariff battle is uncertain, if nothing else, just given we've gone back and forth on reciprocal tariffs. The Federal Panel of International Trade today kind of deemed Trump's 10% reciprocal tariffs on everyone but China as violating the law. So if that holds in 10 days, tariffs on other places go to zero. So it does seem like we're kind of moving towards free trade outside of China. But even China, I just want to reiterate, and I think we talked about this 2 weeks ago, those tariffs have been reduced. We have no details of any potential trade deal or even any plans for future talks, but it is a fact that the tariff on Chinese goods coming into the U.S. was dropped from 145% to 30%, and the tariff on U.S. goods going into China was dropped from 130% to just 10%. So things are moving along, and I think it is important when we look at exports where they stand today and where they're going. Even if China were to buy the same amount of dairy goods from the U.S. that they intended to 4 months ago, I think that's a positive for total U.S. dairy exports. We clearly would like one of the world's largest economies to buy maximum amounts of dairy from the U.S., but even the status quo, I think, leans pretty positive, given where U.S. cheese, butter, whey, and even non-fat dry sit relative to competing markets in the global space. And again, so while the U.S. is improving, things seem to be getting worse elsewhere. So milk production growth in Oceania, which had been fairly strong up until the latter part of winter, has ended. And Europe, maybe the problems are just beginning. And that's, I think, Europe is the big concern when we think about having to adjust trade flows. And this bodes well for cheese. So I don't think there's any evidence with what we know today coming out of Europe production-wise to suggest that there will be a meaningful correction in foreign demand for U.S. cheese. Whether we beat last year's record, I don't know, but I think we will be very close to that. So a lot of cheese will be made to disappear. Combined Oceania production in April was 2.1 million tons, down 0.2%. European plus UK production in March, the latest we've got, was 9.9 million tons, so down fractionally from last year. And so what's interesting is that these are misaligned with the USDA's annual forecast. So EU production through March is down 1.5%, USDA predicts European milk production unchanged year over year. So that's what we've kind of seen in trade and price, market resetting itself. So the USDA, when they revisit these numbers, will have to trim probably Oceania too, but certainly European milk production. And we're starting to digest or account for fewer tons of cheese being exported out of Europe. And assuming that global dairy demand is unchanged from the USDA's current forecast, that just means more tons of cheese have to be put into the export category of the US balance sheet. So it's kind of a matrix. Without, I think, pretty quick and meaningful growth in Europe, that is the scenario that we will contend with in 2025. We will be taking world market share for cheese from Europe, and that's very positive, to, of course, class three. And also, I think cash values of milk through the rest of the year. And so it's going to take some time to really see what Europe did in April, but I think we do have data out of the Netherlands. It is down fractionally from last year. The Netherlands, the third largest producing country in Europe. So unless there is just an incredible performance in France, Germany, the rest of Europe, then I think we're probably dealing with another month fractionally lower production, which further misaligns the USDA's annual trade matrix and European balance sheet forecast. So again, it does not seem like things are improving in Europe, but that they're still pretty stagnant and below last year. So this is positive for US dairy demand. And we've seen that happen. And again, our message is that this probably continues at least throughout summer. And so thinking about, we've got production data through March, April in some places, but we do have a better snapshot of cash prices. And they look very similar to how they've looked really since the fall of 2024. So European cheese this week, $2.35 per pound. US spot market 181. There's a 50-cent discount between the US and Europe and Oceania. So this gap, you can see the red line versus the blue and the black on the left. This is pretty wide. This is certainly wide enough to foreshadow ongoing near record export disappearance. US cheese is cheap. EU butter this week, $3.70 per pound. Oceania butter, $3.55 per pound. The U.S. market is starting to show signs of life, but still at $2.52 is $1 to $1.15 below everyone else. And so again, we've seen the evolution, and this is really important. About 2 months ago, is we've kind of highlighted, and we can see and feel just how cheap the U.S. butter market is to everyone else. But finally, that is translated into net exports, and so I don't think there's any evidence to suggest net exports stop from the U.S. At least through probably September, and that is based more on normal trends in global milk production. We are the opposite of the Southern Hemisphere. So, Oceania, the largest butter exporter on Earth, they just, for all intents and purposes, will produce little to no milk during our summer. So we always see higher prices there. So between now and September, that will help butter disappearance by 3, maybe 6 million pounds per month. And we've lost to the imports that were adding to supplies a year ago and 2 years ago. So just looking at these graphics, what we've seen in the export space will not change for the medium term, at least, not until we get Oceania back in the autumn months. And it kind of more data is starting to tell this story that we kind of saw forthcoming based on international prices. On April 30th, American cheese stocks were 806 million pounds. That is 20 million, or about 2.5% below last year. We probably get to cheese stocks at or above last year. I mean, it was incredibly rapid tightening, but we get stocks above last year by maybe June. But the build has been pretty slow. And I think that build in stocks has been challenged by larger than expected and just kind of outright large export disappearance. So, and especially if you're exporting a lot of cheese and you're the world's cheapest market, it's hard to quantify just how much you'll export. And so even 820 million pounds doesn't mean what it did 3 years ago. When you think about stocks as a percent of consumption or disappearance, it's not that abundant. But I think the big surprise last week was butter inventories. 337 million pounds, down about 7.4% from last year, and below year ago levels for the first time since January of 2024. And this was unexpected, but it does make sense. And I think this is telling the story that one, it's true that net exports, thinking about adding to supplies a year ago with imports of 7 to 10 million pounds. That is gone, and we're making 3 to 5 million pounds disappear. That's part of it. But I think too, when we start to put this puzzle together, we're waiting on production data for April to get total disappearance. I think that butter consumption of all kinds in the month of April will be records by a pretty wide margin. I think it will smash last year's record. So it's the domestic market as well. We're a net exporter. Fat, like it has been the last several years, is very valuable and I think a little undervalued today still. And again, thinking about seasonal trends and butter stocks almost every year peak end of May, maybe end of June. And then it's this kind of rapid contraction in inventories. So thinking about how fast that will be, I think is the butter market's next goal. And it will take some time to sort out, but I think that there is support for pretty incredible tightening of inventories after the middle of summer. We know if we're consuming record amounts domestically now, we know peak consumption is between September and November. And if we're still a net exporter during the autumn months, then we could be dealing with kind of multi-year low inventories come late fall and winter. And the butter market we've seen does account for this, whether it does it ahead of time, very slowly, or like 2 years ago, all at once you add $1 to the market. I do think upsides, today it's something like $2.80, $3. And that probably doesn't happen until after summer, but that is the target, I think, just given the pretty rapid tightening of butter supply and demand. And just to provide some context, this is what that looks like. So, already I've spent a lot of time talking about the transition from adding to supplies with net imports to making supply disappear. And so it's a pretty big deal to go from net imports of 7,000 tons in November to net exports of 1,500 to 2,500 tons today. That's pretty stark change, and it was pretty abrupt. But that these bars are above zero is pretty critical, I think, to butter price discovery, and tells you a lot about just the value that exists in U.S. butter and U.S. fat. Today, it is valuable. We've seen incredibly cheap prices relative to everyone else. The world market is coming to find U.S. butter, and I think in bulk. Kind of as an aside, something we've highlighted the last couple of dairy signals, the whey market, I think, has bottomed and bottomed a lot higher than it was the previous year, and probably on its way up until the end of 2025. Seasonal trends, not guaranteed, but fairly clear in that pretty often the whey market does bottom April and May, like a lot of dairy products, and then kind of work its way up from there into December or maybe January and February. The market today is at 51 cents per pound, was 50 cents in early May, and was 40 cents a year ago at the end of May. So this, I think, just on balance, the arithmetic and calculating things, this is not a negative for class 3 value. So whey market kind of finding some life. I think exports kind of also in play here, and we will make a lot of that stuff disappear. And keep in mind, stocks, at least as of April 30th, March 31st, were down 20% from the previous year. So there's not a lot of whey in the marketplace currently. So that bodes well. So that's kind of the dairy outlook. And again, it's going to be 2 steps forward, 1 step back, but I think it is positive into the earlier middle part of autumn. Now it's the feed market that we're concerned about if we have surplus corn or we're producers of corn. But again, I think that this bodes well for margins for the dairy space. And so kind of like cheese, butter to date, corn's price evolution has been pretty unremarkable as well. It's very intense in December to February because, again, the market was kind of entertaining the need to ration available supplies. We just didn't know if we were going to run out based on the pace of exports then. It's kind of being sorted out, and like normally, this is a 20-year seasonal. You kind of get choppy as we start to get crop condition ratings, the crops in the ground. What does it look like? What do weather forecasts look like? But if you get into about Father's Day and there are no threats, soil moisture is adequate, 2-week, 30-day forecast are pretty normal, then you start to shed supply risk premium more in bulk. Now, seasonal trends are not like secret or magic. This is just the markets digesting a physical supply availability. So, of course, supplies are the largest. They are available to the market, August, September, October, northern hemisphere wide. Then they are the tightest, April, May, and then you kind of start to roll over to new crop thereafter. So I think our concern, or what we want to highlight, is that if you go another week, 2 weeks without U.S. weather threats, northern hemisphere weather threats, most likely we're kind of on our way to harvest lows. We begin that process middle part of June. So, feed coverage, I do think makes good sense on breaks today if you need it for the rest of summer, but thereafter, I think is where we kind of sit back and be patient. I think there is the risk that cash corn gets pretty, don't want to say cheap, but reasonably priced for certain across the Midwest, just before and just after harvest. That period, there's going to be an abundance of corn, which will kind of highlight just how abundant it will be in a minute, but there's going to be no shortage in almost any yield scenario, we think, but barring dire drought in July. And even the tightness of the old crop balance sheet, we're still exporting incredible amounts of corn. We're still using lots of corn for ethanol. I think there is a scenario in that barring a surprise in that residual disappearance, which we never know about, final U.S. corn in stocks could be 1.3 billion bushels. Historically, that is not too far above pipeline minimum supplies, but it is this idea that we're looking at larger production in Brazil. Not a lot of support atmospherically for U.S. climate threats, so I don't think the end user is going to chase rallies. And we're just kind of gearing up for this, shift from demand-driven bull market in corn to probably a supply-driven bear market. And anyway, the cash markets are kind of telling us that is not concerned about supply availability for now or into the end of the crop year. We've highlighted two markets here. Decatur, Illinois, kind of the mothership of the central U.S., paying 4 over for corn for spot delivery. This is a little bit better than last year, but in recent years of concern over supplies and actual supply tightness, you've seen 45 to 60 cents over. That's not the case today. St. Louis, a pretty sizable export terminal, and we're exporting tons and tons of corn. I think we could rival record corn exports this year, but that market's also not terribly phased by supplies that exist or are in position today. St. Louis is about 21 over. If this were a real bull cash led bull market, we'd see 60 to 80 cents over, and that's just not the case. So cash markets are always king to us and telling us the reality of supply and demand, and they're just not telling us much at all. It's been pretty dull there. So I think that's part of the reason why, one, the corn market's kind of starting to roll over, and also the July-December spread, which was pretty sizable, a matter of weeks ago, has dropped to just pennies today. Again, just the expectation from the world market as a whole that we're going to see this ballooning in inventories in a matter of months, and so that's been the dominant thing. That's been the case. It's been no secret that without adverse weather, U.S. corn stocks would be probably at minimum 1.8 billion bushels. But we're kind of getting into the math, and we think it could be as high as 2.2 to 2.4 billion. I don't think that is a market like we saw in 2016, 2018, that's going to tell the world farmer to stop planting corn. It's oversupplied. It's kind of doom and gloom for multiple years, but it is more than adequate, and there's not going to be a rush to put your hands on corn, put your name on supplies, just because there will be more than enough to go around. So I think what we'll be doing over the next 60 days is every day we wake up and kind of assess, is there a threat to this? Is the USDA's number too high or is it too low? And by what degree? And today, a lot of evidence and kind of new weather patterns support, at least now the market's not going to see a threat, and probably not for a couple of weeks. We can kind of see how wet it's been across the central U.S. And so, to be concerned about at least water, we need to see a drying trend first and then some crop stress. And, that might be pushed out already to the latter part of June, I think, given soil moisture today, and probably changes. And in places like Wisconsin and the upper Midwest, the forecast looks, fairly wet there. Nuance, what will final corn acres be? Will there be prevent plant? We would like to see warmth at some point, though I think that happens kind of June 1st onwards. But again, thinking about how the market assesses risk, drought's kind of top of mind, and we don't think that we're going to see that for at least the next several weeks. But I think what is unique to the corn market this week is rising estimates of Brazilian corn. And I think the expectation or probability that Brazilian corn will be abundant, and to the point where they offset, the crop size there will offset what's been an explosion in ethanol production. So even the USDA's updated forecast, Brazilian corn production this year, 130 million tons, second largest on record, and up 11 million tons from last year. They still would not increase their exportable surplus because the ethanol industry is going to take all of the increase in production. But now I think the idea is that we're starting to cross that threshold. Will Brazil have an extra 100 million, 200 million bushels to export, between October and December? And it's difficult. The market, especially the private sector, is pretty bad at estimating Brazilian crop sizes. But I will walk you through why we think that odds are good that the U.S. corn market will have to compete pretty fiercely with Brazil starting August 1st. From the left, you've got April 1st to May 28th, percent of normal rainfall. The highlighted area is the Safrinha or winter corn belt. That crop pollinates, between April and the end of May, and you can kind of see that you saw rainfall totals, 150 to 300% of normal. So not only did they avoid, an early season exit of the wet season, but they saw above normal rain, and it's still raining in Brazil, and it's highly abnormal. So then you check in, what does the sort of objective satellite data look like? On the right, you've got vegetation health, sort of cropland isolated as of May 24th. And you can see it's very green. So whether you compare it to average or last year, it does look much improved. That doesn't really get us close to a precise number, but I think there is higher odds that, the USDA's forecast is understated by 2 to 5 million tons. And probably most of that does get exported, at least some of it. And so the Brazilian market has been shedding its own risk premium because, again, not only have they avoided adverse weather, but for the first time in recent memory, they got rain during pollination, which is pretty unusual. Usually, that crop, again, is 85 bushels an acre because they don't have the water. This year they did. And so this is fairly unique. And just to show you how unique this is, they are still getting rainfall. This is the 10-day forecast. The Safrinha corn belt is highlighted again. And of course, it's not everywhere. And these aren't, for the most part, big totals. But, certain farms will get, an inch or 2 inches of rain between May 29th and June 8th. And this is about 400% of normal rainfall, even half an inch. So it usually just shuts off entirely during the Northern Hemisphere, sort of spring and summer, but it just hasn't been the case yet. So this should be a very, very sizable Brazilian corn crop. And as we debate U.S. yields, I don't know what happens there. And I know that we can shift from adequate rainfall in May to drought during the summer. That is not unprecedented. But this is, I think, what we're focusing on with respect to risk in the corn market. Currently, it's more, top of mind to us is just competition for demand. We'll assess yields 30, 60, 90 days from now, but we certainly know the Brazilian corn crop will be large. This is what their market looks like. So again, kind of waiting, ethanol explosion, taking a lot of domestic supplies. Market was very slow to correct. Still close to $6 a bushel 30 days ago. Now the interior cash corn market is down to $5.16. That is down 15 cents from yesterday. So we're kind of sliding into seasonal lows, which probably occur in July and August. And we're also seeing Brazil for the first time, really in about 12 months, be offered cheaper than the U.S. for summer delivery, but also we can kind of see offers out into December, and it does look like they're just now starting to compete. And that is probably the sum of that market thinking production's big, we'll have more than enough to meet ethanol demand growth. What do we do with the rest of the supply? We're going to shove it out into the world market. So again, one of the drivers of corn prices, why we saw a $5.15 corn was the U.S. corn throughout the last 9 months, has been the world's low-cost origin. Similar to butter, the market has responded. We have exported an incredible amount of corn, but that's transitioned in just the last week. So now, at least compared to South America, the U.S. Corn is the high-cost origin, just because we're seeing premium be extracted from the South American market. So I think this will be a slow process. The Brazilian winter corn harvest will not be complete until the very early days of August. But, importers tend to buy 60, 90 days in advance. So they're probably already thinking about at least, sharing their needs with the U.S. and South America. It's just very different than what it's been the last 6 months. We can no longer say U.S. corn is ultra cheap in the global space like butter is. Now it's competitive, kind of losing some of its edge. And I suspect if we do prove that the Brazilian crop is 135 million tons, the Brazilian cash market will weaken further, looking for demand. So again, part of this is just assessing, it's been 9 years since we've had any real meaningful growth in global productivity of the major crops combined. So what we'll be doing the next several weeks is assessing whether this is the first year that we do see yield growth. And so far we've got, Argentina did pretty well. Brazil's corn crop's doing very well. Brazil's soybean crop did pretty well. And also the Europe and the Black Sea region, pretty sizable producer of canola, winter crops like wheat and barley, also doing pretty well. So this is the May 1st to June 6th percent of normal rainfall. You see the major grain producing areas highlighted with red circles, and some dryness lingers in France. That's important, but for the most part, we don't find any real problems there. The wheat crop in Europe is kind of made in the month of June. So if you don't see a big change to heat and dryness, they probably are locked into, Europe is forecast to increase wheat production by 16 million tons and corn production by a couple of million tons. Last year, crippling drought during the summer in Ukraine really weighed on vegetable oils and corn production there, which ultimately funneled demand to the U.S. market. But if they recover, then Ukraine will have another 8 million tons of corn over last year. So these numbers are kind of starting to add up to where, again, where we'll have a watchful eye on potential weather threats. But for now, so far, it seems like there's a lot of evidence to support record global crop yields, at least in the Northern Hemisphere in 2025. And so thinking about the corn market again and how the market kind of sorts out supply, demand, and price. So Brazil, Argentina, more or less locked in. Again, I think we'll debate Brazil for a few weeks longer. And Ukraine, this assumes normal weather. It also assumes trend yield in the U.S. But if those things occur, I think that is one of the risks in the market. If that's the case, then in calendar year 2025, the exporters will combine to produce a corn crop of 612 to maybe 620 million tons. That is up 37 to 45 million tons from last year, or 1.5 to 1.8 billion bushels. And so again, I think we're dealing with a nuanced market like last year. Seasonal trends are weak into harvest, and then kind of the market rebounds after that. But just thinking about having 1.5 billion additional bushels available on October 15th compared to the previous year worldwide. What does the market do with all of that? And I think it is probably one that has to probe for additional demand, whether it's biofuels and ethanol, or trying to encourage importers to restock something, and none of that's terribly bullish of price. Now, how fast we use all this extra production will be an issue come, December, January of next year. But for now, it's just that concern that we're going to have 1.5 billion more bushels during the autumn. Competition for demand just not real good to sustain rallies. And again, we don't have the crystal ball that tells us what happens to U.S. weather and U.S. yields. We just want to highlight some things that have changed in the last 30 days. So one of the risks, I think, and this was kind of a pretty big talking point amongst the climate community, was there's a lot of support for this northerly alignment of the jet stream. And so everyone's kind of on board with heat and dryness west of the Mississippi, at least during the summer months. And even the U.S. Weather Service, just 30 days ago, was pretty confident in that forecast, doing the best they could. But we've just seen such an abundance of rain since then that you see on the right the change in drought coverage over the last 8 weeks, and current drought on the left. It's gotten so much smaller to the point where outside of Nebraska, parts of the Dakotas, and really in the northern third of Illinois, there's adequate to surplus soil moisture. And probably more on the way as well. So again, water availability, especially at this stage in the growing season, not an issue, and probably won't be an issue for the next 10 days, maybe 2 weeks. And so there's been pretty consistent forecast that finally, I think the thing we need most is heat at this point, but it does look much better June 1st onward. I think we will get highs in the 70s and 80s on a sustained basis finally. So that's very good. And the models and the Weather Service have also been pretty consistent in projecting at least high odds of pretty heavy rainfall from Minnesota, Wisconsin, and Michigan. Maybe this expands into the Dakotas as well. So drought coverage on paper probably even gets smaller over the next 2 weeks. And again, it's a long season. Too much water can be an issue, but just thinking about how the market sorts this out, we've got to be cognizant of. And I think since the last 30 days have been so wet and drought coverage has contracted so much, even these long range computer models, which we don't have a lot of faith in anyway, have been forced to adjust wetter and a bit cooler. So, looking at the June precip probability map, which is displayed here, 30 days ago, it looked very, very dry and very hot. But now it's kind of accounting for, drought begets more drought and vice versa. So, surplus soil moisture tends to promote a lack of heat, additional rainfall, and that's what these maps at least are showing us now. And these are updated every day. This will not catch us by surprise. But again, it's kind of hard to identify as much as it matters in late May and early June, threat to the USDA's yield forecast. So is this a year that we cross the 180 bushel per acre corn yield threshold? Do we get to 52.5, 53 soybean yields? Again, we will revisit this every month, but today I just want to show you what the market is seeing and what the weather gurus are saying, that we don't really identify any drought development, at least into the maybe middle part of summer. And to that end, the thing we check in, every day, what is the Gulf of Alaska doing? Droughts tend to develop in the Midwest if the Gulf of Alaska is cooler than normal. Today, the highlighted area in the black circle is warmer than normal. So just kind of the simplest way to explain this is, evaporation is accelerated. That water tends to flow along the jet stream into the eastern plains and Midwest, and that should continue, I think, fairly regularly, at least for the foreseeable future. But again, these graphics, these forecasts, updated daily. I don't think potential drought will catch us by surprise, but today does look pretty good when we think about water, at least. And kind of finally, we look at whether we're in La Nina or El Nino. La Nina on balance pretty bad for global crop yields. El Nino higher odds that crop yields globally exceed trends. We're in neither of those. This should be a year of no Nina, which opens a possibility to all kinds of weather scenarios, but also it's not La Nina. So I think odds are 50-50 at least that we'll see pretty regular growing conditions across the Northern Hemisphere. And keep in mind, Europe, the Black Sea, the United States, all doing pretty well with water today. And so we kind of explore what's happening in U.S. corn supply and demand. And so we've got to keep all kinds of scenarios, yield scenarios, maybe export scenarios, if there is some kind of deal struck between the U.S. and China. But we hear none of that today. And that may have to be measured in, years rather than weeks and months. But in these scenarios, we kind of feature, old crop carryover just under 1.35 billion bushels, incredibly tight market. But we've added probably 5 or 6 million acres to production this year. And so we kind of explore maybe the USDA is overstating its new crop export forecast just because of Brazil. So it's 2.4, or if it's 2.3 billion bushels instead of 2.7, you're kind of stuck with 2.1, 2.2 billion bushel in stocks. Again, that's a $4 market. Harvest low is probably below $4. And that's the risk as of today. We will assess this with every 6-hour update in the weather forecast, but today this is kind of our concern in the corn market if you're a producer. Now, again, this does help milk feed ratios widen, but just wanted to highlight that an abundance of corn is the most likely scenario. We haven't really touched on soybeans or soybean meal, and not much has changed there. I think the soybean meal market, like I said before, is stuck. I don't think you can be bearish of soy meal, but you also have to see a pretty big threat to soybean production to be bullish of protein meal. You can buy it today. You can buy it 30 days from now. I guess did want to highlight that there is some support for higher prices, at least during summer, just because we crush fewer bushels of soybeans. So on the right, we've got monthly soybean meal production, at least from the NOPA members. I've highlighted the summer months. This happens year in, year out, but I think supply availability, like it does every year, will be a little diminished during the summer. So again, I wouldn't wait for 260 soybean meal, but rather as you get corrections, I think it does make sense to secure protein meal needs, especially given the milk soybean meal ratio. Right? It's probably gets a little wider, but maybe not much. But weather still does matter. We do have an entire growing season to go. The wheat market, for example, will be pretty adequately supplied if the USDA's yield is correct, which we see no threats to today. But if there's drought in Canada, if the Southern Hemisphere this fall doesn't perform very well and you lose just 2% of the exported wheat yield, you're down to kind of a historically tight global wheat balance sheet. And the same is true in corn. I think if our work would suggest if you had 181 bushel an acre corn yield, you're building global corn stocks. It's a $4 market. But if, again, who knows if US corn yield is 175, you're all of a sudden you're not building stocks at all, and export and balance sheet stays pretty tight, and then the market's got to add premium. So this is just something that we'll debate. Again, I think the default scenario is for lower corn prices because of weather patterns, but it's going to matter. There is going to be volatility during the summer months. So again, lots of issues. We didn't even touch on trade policy because it's so uncertain today, but not terribly relevant for ag market price discovery right now. But again, kind of the high level message is that milk looks good to us. Feed market's probably correct, and those feed margins get wider than they are today, if just a little bit. So as always, if you have any questions after this, please reach out. We're happy to help with risk management. But any all questions, rebuttals, complaints are welcome.
Well, I don't think we have any complaints when you're telling us that milk price is gonna hopefully be staying steady here, and that's from a dairy producer, that's not a bad thing. But
Yeah.
we've got a couple questions that have come in, and the first one here reads, well, I mean, I guess we kind of touched on this one, but if you could reiterate, it reads, how long do you think US cheddar will remain lowest on global scale for price? Do we think long term, given the world production issues, we will remain there for the rest of 25?
I think the answer is yes. I cannot see European values correcting. Uh, New Zealand is not as important with cheese, but still does export a decent amount. They are kind of out of the market again, like they are every year, until about September, maybe October. So at least until October, I think the U.S. cheese market either goes to meet world values or we see record exports. And in any case, that keeps prices, neutral to higher for the next 4, maybe 5 months.
Okay. Next question here reads, what can we do to further stimulate export demand for dairy products?
Probably, outside of just the market doing what it's doing today, which I think it's doing a really good job at stimulating exports. And I think too, a tangent, but we still have this idea that global dairy consumption is going to grow pretty normally. Call it 0.8, 1% per year. You ultimately add 3 or 5 million tons to trade over the next decade. Europe's issues are structural, long term, probably unlikely to be solved. New Zealand's out of land. Yield growth there is pretty minimal. I think we fill a majority of that. But for now, it's probably what we can do short term is trade deals, which is out of all of our hands, and we don't see really any evidence or concrete details surrounding those. But I think markets like India would be a big deal. They do have a need for some dairy products, even if it's politically based. That would kind of jump our stuff. And I guess to a trade deal with China, China ebbs and flows with their non-fat dry needs from the U.S. Way as well. And so if we do kind of lock in that Chinese market politically, then that bodes pretty well for the rest of 2025 or
Well,
2026, whenever we can strike that deal.
sounds good. And speaking of China, I'm gonna go right there for the next question here because it reads, so for US Ag, the trade situation with China is the top priority.
I think so. I mean, if you really want to find a new demand driver, and it's different. I mean, they're kind of opposite when we think about dairy doing very well, and grains and oilseeds not doing as well. Now we can't today find really any one big grain oilseed demand driver. The most recent one, 2020 to 2022, was Chinese imports, and so it's hard to separate whether that was phase one. Certainly, partially it was, or if China needed the foodstuffs imported. But yes, to grow, find a new demand driver for corn, wheat, and soy products, it would be negotiating with China. Yes.
Okay. And as of right now, final question for the day reads, will the US be able to sustain the current butter demand, or are we in for a rude awakening if EU production turns around and we have more stocks than needed?
It's a very good question. And, I don't want to get too far ahead of myself, but again, I think that it's two-sided. Again, I think that these competing markets are going to struggle to grow milk production. Dairy consumption as a whole, growth has been pretty steady, and butter consumption. I mean, we can always talk about the breakfast patterns, things like that, but there's something happening. Fat demand globally is pretty incredible. So I don't think that those change in the short run. So I do think that butter demand kind of finds new records for the next couple of years. And if Oceania doesn't start producing more milk, then we probably continue to export it. So I think the butter outlook's pretty good.
Okay. Well, definitely keeping an eye on what's all happening in the world. And it's always appreciated that you're here, Ben, to help us kind of break it down and go through what we need to be keeping an eye on or maybe looking at a little bit closer. So thank you so much for your time here this afternoon.
My pleasure. Thank you.
I also have to say, if you are somebody who's wondering what's going on in the world of professional dairy producers, I encourage you to head over to our website where you can learn more about our great programs, including our Your Farm, Your Footprint initiative for sustainability, as well as our upcoming programs, including a fantastic international tour to New Zealand. I think there are literally just one or two spots left. So if you are been itching to get there, I would highly recommend you head over there to look at it. But with all of that being said, we have so much more. So head over to our website at pdpw.org to learn all about it. For now, thank you for joining us here today, and we'll see you here next week on the Dairy Signal. Bye now.